When you talk to clients about bond markets and whether bonds are suitable for somebody's portfolio, what are the dynamics that you look at?
The number one thing might be the yield. Is how much yield are you getting in your bond compared to what you could get elsewhere. So let's say your bond was yielding you something like 4.5%. Then if you're locking your money up in the bond, you have to believe that that's going to be a better investment than putting your money in, say, stocks. And oftentimes is the case, especially in the last decade, you would get your bond return was quite low, so it made much more sense to put money into stocks. Now that bonds are at a much higher yield level, it makes potentially more sense to put your money into there because it's a less risky type of asset. Then the second thing to consider is the yield at which you're locking that in. Mm-hmm. So if you think that the yields are going to come down from here, it would make sense to lock at yields today, which is one thing that's kind of attractive today. Rates are fairly elevated at this point, so it kind of makes sense to lock in rates at this juncture.